At the end of 2024, mortgage rates are hovering around 7%, the highest we've seen in over 20 years. Naturally, many future home buyers are waiting on the sidelines, holding out for the lower rates we just saw a few years ago. If you're itching to buy a home, whether it's the first home you're buying, or you're tired of renting, or you're ready to move out of a shared living situation, you're probably wondering, should I buy now or wait for rates to drop? Is now the right time to buy? So, should you wait? And if you do buy, how do you avoid overpaying on interest? While interest rates are important, they are not the only factor that you have to consider. Even with the high rates, I say buy. In this video, I'll show you how to navigate buying a home in a high rate environment, and I'll show you strategies that could save you thousands, even tens of thousands over the life of your loan. Plus, stay until the end because I'll reveal a combination of strategies that can help you save big on interest and potentially cut years off of your mortgage term. Let's start with some context. Back in January 2021, Freddie Mac reported record low interest rates of 2.65%. Some buyers even locked in at lower rates because they had larger down payments. But chances are, if you're watching this, you didn't buy back then. Maybe the timing wasn't right or your circumstances didn't align. Today, with rates at around 7%, buying a home costs significantly more. For example, on a $500,000 mortgage, the difference in interest between a 4% and a 7% over 30 years is a staggering $340,000 just in interest.
What?
So why are rates so high? Several economic factors play a role, including inflation and federal monetary policy. Those historically low rates during the pandemic were an anomaly, and experts predict we won't see them again in our lifetimes. But this doesn't mean you have to abandon your dream of homeownership. People bought homes even when rates were in the double digits in the 1980s. And there are strategies to make buying in today's market a smart move. So let's talk about those strategies. First up, buying down your rate with discount points. This means prepaying some of the interest up front to secure a lower rate for the life of the loan. For example, on a $500,000 mortgage, again, 1 point costs $5,000 and typically reduces your rate by 0.25%. If your rate drops from 7% to 6.5%, your monthly payments decreases by $167, saving you $60,000 over 30 years. Buying points makes sense the most if you plan to stay in your home long enough to recoup the upfront cost. To calculate this, divide the cost of the points by your monthly savings. If you take 4 years to break even and you plan to stay longer than that, buying points could be a smart investment. Keep in mind, points might also be tax deductible as mortgage interest, so make sure you consult your tax professional for details. However, this strategy isn't for everyone. If the upfront cost stretches your budget, or you plan to refinance, or you plan to move in a couple of years, it may not be worth it. Always ask your lender to run the numbers for your specific loan. The second strategy is putting down a larger down payment. A bigger down payment reduces the amount you need to borrow, which means smaller monthly payments, less total interest, and potentially avoiding private mortgage insurance or PMI. For instance, on a $500,000 home, putting down 30% instead of 20% reduces your loan from $400,000 to $350,000. At a 7% rate, that saves you $333 per month and nearly $120,000 in interest over 30 years. Plus, avoiding PMI can save hundreds of dollars monthly. PMI typically costs from 0.5% to 1% of your loan amount annually, which adds up very quickly. Beyond the financial savings, a larger down payment gives you more flexibility in the future, like refinancing to a better rate or accessing home equity loans. That said, don't deplete your savings or emergency fund just to put more down. If you qualify for a low down payment program like FHA or a VA loan, or if investing your cash elsewhere provides a better return, it may make sense to stick with a smaller down payment. The third strategy, and my personal favorite, is making extra payments towards your mortgage principal. Even small, consistent extra payments can save you tens of thousands of dollars in interest and shave years off of your loan. Let's say you have a $500,000 loan at 7%. Adding $200 extra each month saves you approximately $126,000 in interest and shortens your loan by 5 years. Bump that to $500 extra per month, and you could save nearly $230,000 and cut 9 years off of your term. This strategy is incredibly flexible. If money is tight one month, you can skip the extra payment without penalty. Plus, you're building equity faster, which opens up options like refinancing or selling your home for more profit. You can round up your monthly payment, switch to bi-weekly payments, or use windfalls like tax refunds or bonuses to chip away at your balance. Finally, let's talk about refinancing. This is the go-to strategy for many buyers when rates eventually drop. Refinancing allows you to lock in a lower rate and potentially lower your monthly payment. However, refinancing isn't free. It comes with closing costs that typically range from 2 to 5% of your loan amount. It's worth it only if the long-term savings outweigh the upfront costs. Combining strategies like smart down payments, lump sum payments, and regular extra contributions can make a significant difference when managing higher interest rates. For instance, if you have more than 20% saved for a down payment, consider sticking to 20% to avoid private mortgage insurance or PMI and use the extra funds for updates, repairs, or as a reserve. Once you're settled, you can begin making lump sum payments toward the principal and adding extra to your monthly or bi-weekly payments to reduce your loan length and total interest paid. These small, consistent actions can save you thousands of dollars over time and bring you closer to financial freedom. Yes, rates around 7% mean higher monthly payments, but they also create opportunities in a less competitive market. Waiting for rates to drop might leave you facing higher home prices and intense buyer competition. If you're ready to leave renting or shared living behind, purchasing a home could still be the right move for you. Homeownership isn't just about finances. It's about having a space that's truly yours, where you can create memories and take pride in your investment. Keep in mind, buying a home isn't for everyone, and that's okay. The decision should align with your goals, finances, and comfort level. My role as a real estate agent is to inform, not pressure. Real estate, like any major financial decision, involves calculated risks, but with the right strategies and trusted professionals, it's entirely achievable. Remember, even in the early 1980s, when interest rates soared to an astonishing 18.45%, people still bought homes. If they could do it then, you can absolutely navigate today's market with the tools and knowledge we've discussed. Interest rates are just one piece of the puzzle. It's important you understand the other moving parts to the process. If you enjoyed this video, don't forget to like, subscribe, and grab your free homeowner's guide, link in the description below. What do you think about these high interest rates we're currently in? Are you buying, or are you going to stay on the sidelines and wait for a better time? I want to hear your thoughts. And if you have any questions about anything real estate, drop them in the comments below. Thanks for watching, and happy house hunting.